welcome you to today's part of the Center for Politics and Governance's speaker series. My name is Ryan Streeter. I'm the Executive Director of the Center, and it's great to have you all here today for this talk on Too Big to Fail, a topic that's very relevant to the policy debates we're having right now. If you'd like to come to more of these events and you're not in our system, be sure to stop and see Lauren and Hannah on your way out to get registered for, or to get on our list for future events. We'll be happy to have you back. I'm really delighted today and honored to have Jim Barth here, who's the Lowder Eminent Scholar in Finance at Auburn University and is also a fellow with the Milken Institute and a fellow at the Wharton Financial Institutions Center. If I tried to walk through everything that Dr. Barth has done in his career, it would take the first 10 minutes, so I won't do that. Just hit the high points. He has been the head of an international team that's advised the People's Bank of China on banking reform, and also in several U.S. administrations has served as the chief economist at several different institutions, including the Office of Thrift Supervision and the Board of the Federal Home Loan Banks. He's authored over 300 articles in scholarly journals and public press, and has authored and edited a number of books as well. If you haven't seen them, most recently his books are Guardians of Finance, Making Regulators Work for Us, with MIT Press that came out a few years ago, and then also Fixing the Housing Market, Financial Innovations for the Future. And you can learn a lot more about him if you go to his page online. So please join me in welcoming Dr. Barth to UT.
Okay, thank you very much, Ryan. It's really a pleasure to be here. My second time on your campus. Last time I was there, I spoke in the William D. Johnson School of Public Affairs. Do I have it right? Yeah. Dealing with fraud, control of fraud, that sort of topic with financial institutions. You can see the title of the talk is Too Big to Fail. I'm talking about banks, big banks. And I have a co-author. I wrote a paper. It's available SSR, and it's also available on my website here if you wish to learn more about me. Most of my talks, my presentations, and papers are available at the website. So if you want to know more, you can go there. You might ask me to use Jim. I think it's on. It is on.
Is that better? Does that help? I don't notice any difference.
Okay. You're free, if you wish, to stop me and ask me questions. Of course, I'm free to either answer or not answer your questions. So those are the ground rules. But do stop me. We have a limited amount of time. As you know, when you teach, you usually teach for about an hour and a half or so. I have less than that amount of time to cover the topic, and there's a lot to be said. The slides probably have more information than I'm going to talk about today, but of course you are free to look at the slides, send me any questions or any comments if you wish. When I arrived over at the A&T Center, I looked at a paper here, the Daily Texan, and it does relate to my talk today, and you wonder how it relates to my talk. There's a piece here, 1984, Lakers center Kareem Abdul-Jabbar sets the NBA career scoring record, passing Wilt Chamberlain's mark of 31,419 points. What does that have to do with Too Big to Fail? Does anybody know? What it has to do with Too Big to Fail is 1984 in the United States is when we first identified some institutions as too big to fail. And we identified 11 institutions as too big to fail in 1984. In a more recent period of time, the former chairman of the Federal Reserve, Ben Bernanke, identified 19 institutions as too big to fail. So what I'm going to do is talk about too big to fail. I'll talk about banking institutions. I was at a conference, incidentally, just over 2 weeks ago in London. It was a conference held at the Bank of England, which people there were invited to talk about too big to fail and a variety of topics. I will say a little bit about perhaps what some of the people said at that conference. And there was also a conference yesterday at the Federal Reserve Bank of Minneapolis. The new president of the Federal Reserve Bank of Minneapolis, Neil Khashoggi, has said the Dodd-Frank Act, a piece of legislation, the most recent piece of legislation dealing with reforming the financial sector, and particularly the banking sector, does not actually resolve the too big to fail problem. So Neil Khashoggi has said by the end of the year, he and his colleagues at the Federal Reserve Bank of Minneapolis are going to come with proposals to finally deal with the too big to fail problem. And one of the proposals he's considering is breaking up the big banks. So I'll say something about breaking up the big banks. Just so you know where I stand, I'm not in favor of breaking up the big banks. So I may as well tell you right at the outset my view about breaking up big banks. And I'll try to explain why, and if I don't do a good job as I work through some of the slides, you can ask me to be a bit more specific. It turns out when I start talking about addressing too big to fail problem, the objective is to reduce systemic risk, and there are different types of systemic risk. We usually think of bank runs, but there's also contagion, other types of systemic risk. I'm not going to talk about the different types, but there's some pretty good finance people who are now trying to come up with different ways to measure systemic risk. That has been done, as we know, by some individuals. It also turns out there's an individual that I've worked with, I've published a few papers with, Franklin Allen, who's now housed in England, who basically has given a talk. He gave a talk on the same panel as me just a couple of weeks ago, trying to identify many different types of systemic risk, believing that different types of systemic risk lead to different sort of proposals for reform. So we also want to eliminate big bank bailouts, which we have done, and I'll say a little bit about that. The issue, though, is if we reform our banking sector, do we achieve stability as well as efficiency in the banking sector, or are there trade-offs between the two? And what I'm going to do is, as you can see here, start out, say, how big is big? Then I'm going to turn to, are big banks complex banks? Perhaps it's not just an issue of size of a bank, but the complexity of a bank and some other related issues. Then I'm going to talk about whether or not we should restrict the size of banks, say something about whether or not we should restrict the scope of banks, then talk a little bit about whether we should simply require more and different types of capital in banking institutions. It turns out Anat Admati, who's a finance professor at Stanford, also was at this conference. So I had the opportunity, she asked me to go to dinner when we were there, so we ended up spending about 5 hours talking about her views on whether or not we should raise capital and by how much, so on and so forth. So of course, I'll say something about her views on raising capital. She's received a lot of attention. The banks aren't all that happy with her proposal to raise capital because of the amount that she wants banks to have to raise. So I'll say a little bit about whether simply raising capital is sufficient or not. And then I'll talk a little bit about what happens if a big bank fails now as a result of the Dodd-Frank Act of July 2010. And then I'll talk a little bit about combining approaches. So how big is big? It turns out this is just a slide showing you the world's biggest banks. What I have done is simply identified the 100 biggest banks in the United States by assets. And it turns out the 100 biggest banks account for 75% of all bank assets worldwide. And we're talking about, does anybody know incidentally how many countries there are in the world? It's usually a question I like asking. Any idea? 200 is a good number, okay. About 220, but we don't know exactly, okay. There are some difficulties knowing how many countries there are. But these banks are located in just 25 countries. So we only have to go to 25 countries and we find the biggest banks in the world, if we rank them by assets. And you can see, we get 5 banks in the account for 14% of assets. So that's a way to measure bigness, just how many banks account for what percentage of all banking assets worldwide. It turns out if we look at the 50 biggest banks, they've gotten bigger over time relative to GDP. That's another way in which to talk about bigness, the size of a bank or a collection of banks relative to GDP of the countries in which the banks are headquartered. I'll say something more about that because there's an MIT economist, Simon Johnson, who has said something about limiting the size of banks. And I'll tell you his proposal what he says about it. And I'll also tell you I disagree with his proposal, which he's put forward, and I'll try to explain why if I have time. But you can see the big banks have gotten bigger over time from 1970 through the third quarter of 2015. That's another way of talking about bigness, not just absolute size or share of total assets of any one bank or collection of banks, but the assets of a collection of banks, one or more, relative to GDP in which country which the banks are headquartered. This is the U.S., so I just shift to the U.S. now, and you can see the combined assets of the 50 biggest bank holding companies. Now I'm talking about banks, and I'm focused on bank holding companies. The subsidiary of the banks, holding companies may be banks, but they may be insurance companies, securities firms. So again, a difference in terminology perhaps or focus. But you can see here in the fourth quarter of 2015, it turns out that the bank assets of the 50 largest bank holding companies were 89% of our GDP in this country. If you know GDP, you know roughly what the bank assets are, okay, the holding companies. And they've gotten bigger over time. And again, we started off talking about too big of in 1984. So the regulatory authorities have allowed banks, big banks, to get even bigger over time, both as a share of total assets or relative to GDP. There are 4 or 5 bank holding companies in the United States that control just over half of all banking assets of all holding companies in the United States today. Now, moving from how big is big, what about complexity? This shows you some of the biggest banks, and this is just my selection of some of the biggest banks among the 100 biggest banks in the world. Their revenue mix, some comes from overseas, that is outside the country in which the banks are headquarters. Some comes within the country. JP Morgan Chase, you can see, gets about half its revenue from outside the United States. So if you talk about complexity, a bank is more complex if it's operating in many different countries. Incidentally, the world's 100 biggest banks, I told you, operate in 25 countries, but some of these banks operate in many more countries in various parts of the world. So you can see, not all banks operate internationally. Wells Fargo was a bank, one of the biggest in the United States today, highly valued based on market value, and it turns out that's largely a domestic bank, not an international bank, unlike Citigroup or JP Morgan Chase. It turns out their assets, many of the assets, some of the big banks are outside the country in which the banks are headquartered. This becomes an issue, as I'll mention later, if a bank gets into trouble because it's too big to fail. What do you do if a bank is operating across national borders in many different countries? It's very complex, perhaps, to deal with that particular bank. Perhaps it's not just the size of the bank, but its complexity in terms of where it's operating, how many different countries. That tells you whether or not perhaps that bank might be bailed out, despite the most recent law and perhaps why some banks had to be bailed out in earlier years. It turns out this basically tells us a little bit about the subsidiaries of banks. Okay, and as you know, a holding company can have many different subsidiaries. It turns out if we focus on just JP Morgan Chase, you can see it has $2.5 trillion in assets. And this is as of the third quarter of 2015. Now, there's an issue. Anybody an accounting person in the room? Taking accounting? If you know anything about accounting, you know there's US GAAP and there's also international financial reporting standards. They differ with respect to the treatment of some items, in particular derivatives. It turns out under IFRS, derivatives are treated on a gross basis, so they show up in total assets for a bank. In the US, under US GAAP, we net derivatives, okay? If you add or you shift JP Morgan Chase from US GAAP to international financial reporting standards, you're at about $900 billion in assets to JP Morgan Chase. So it tells you when you compare banks, you have to know something about accounting. Some countries use both. Switzerland uses IFRS and it uses Swiss GAAP. China will use Chinese GAAP and sometimes IFRS. Most of European countries are now using IFRS. So when we do these sorts of comparisons, you have to know a little bit about accounting. So how big is big? It also depends on the accounting procedures or or methods that you use. So you can see, though, importantly, J.P. Morgan Chase has over 5,000 subsidiaries. And you can see just over half of those subsidiaries are outside the United States and located in 72 different countries, a lot of different countries. Can you imagine if this bank gets into trouble again and it had to be resolved, go through bankruptcy, or be resolved by the bank regulatory authorities? How do you deal with all those subsidiaries? And I'll come back to this type of issue a little bit later. This is the biggest issue, incidentally, with whether or not Dodd-Frank Act is going to be sure that we never have to bail out another bank because of not so much just size, but also the complexity issue dealing with this many subsidiaries. And if you ask yourself, if you're a finance person or you're an economist, are these subsidiaries all based on synergies, all based on economies of scope or something? Can you rationally explain that indeed this is all makes economic sense and enhances the market value or the efficiency of a bank with this many subsidiaries in so many different countries? So should we restrict the size of banks? How do you go about doing it? Now, let me jump to Simon Johnson, who has advocated limiting the size of banks. What does he say? He says we should limit the size of a bank to 2% of GDP. That's his proposal. He doesn't say a lot more about it. He just simply says we should limit the size of a bank to 2% of GDP. Now, I won't go through and show you how that affects different banks in the United States. So if GDP goes up, a bank's asset size can go up. He doesn't talk really about whether he's going to use US GAAP or he's going to use IFRS. It would make a difference, as I just told you. So is it simply absolute size? Is it the share of total assets? He doesn't say that, but some people might say no bank should account for more than X% of total assets in the US banking system. What about assets to GDP, which he does? Well, is it all assets or a subset of assets? Would you exclude Treasury securities, arguing that they aren't really risky at all, there's no credit risk? Take them out. Would you basically take the GDP of all the countries in which the bank's located and their assets in those countries? So you sort of start saying assets of J.P. Morgan Chase, and you have to worry about the assets located in 75 different countries? Or would you just take domestic assets by domestic GDP? Those are questions Simon Johnson hasn't yet answered or said much about. And then, of course, would you do this around the world with the Basel Committee or the Financial Stability Board? These are two sort of international regulatory type agencies. The Financial Stability Board reports to the G20 countries, and then the Basel Committee, the bank, has also a supervisory group. But the more important one is now the Financial Stability Board. Should they issue guidelines saying that basically size of banks should be restricted or limited somehow? Should banks be broken up? How do you break them up? I'll come back to that. So there is this issue of what we do. Nobody has basically demonstrated conclusively there are economies of scale associated with size or economies of scope if we talk about a wide range of activities. And a lot of these banks have different business models, which, again, I don't have time to go into. There are academics who find there are indeed economies of scale, bigger banks, okay? When they get bigger, the costs go up less than in proportion to total assets. So, again, there may be economies of scale. That would be a cost of breaking up banks or restricting the size of banks. That could adversely affect individuals. Think of where you bank today. If you bank at a big bank and it's broken up or restricted, does that somehow affect your banking practices? What about big corporations? What do they do if you restrict their size? Do they basically service the same sort of companies? Can they compete globally when you have big banks? Big banks in China. China has 5 now. It used to have 4, but 5 state-owned banks. They have some pretty big banks. Some of them operate in the United States, some operate in other countries. Does that limit U.S. banks if we limit their size to compete globally with other big banks? Sort of an issue. So, again, restrict the scope and I won't go through all of them. Everyone probably knows well, maybe you don't, about the Volcker Rule. There was a former chairman of the Federal Reserve, a fellow named Paul Volcker, and he basically said no bank should engage in proprietary trading. It turns out, I think that's wrong. I have no objection to any bank engaging in proprietary trading. That is trading and securities on its own account. I happen to testify against the Volcker, and with me testifying in favor of the vote was Simon Johnson, incidentally. It turns out he was in favor of the Volcker. The financial crisis we had in the United States, the one that occurred in 2007, 2008, the worst financial crisis since the Great Depression, was not caused by the Volcker Rule. It was not caused, basically, by banks engaging in securities activity, or the merger or allowance for banks to engage in also securities activities, in my view, okay? So some people say that's a problem or it was a problem. I don't think it was. So the Volcker Rule, I don't think, did anything with respect to preventing another banking crisis. And I don't think the mixing of banking and securities activities, or even insurance activities, caused the crisis or was a source of a problem that we have to really worry about. So again, we have ring fencing in European countries. You try to take the traditional bank and you put up Chinese sort of walls between the bank and, say, investment banking activities or other activities. So you try to separate out certain types of activities. And in some cases, as I just mentioned, we just want banks not to engage in certain types of activities. But are there any economies of scope? Is it beneficial from an economic standpoint or financial standpoint to allow banks to engage in a wider range of activities? And as I said, over a wider geographical area. So again, there have been proposals to limit the activities in which banks can engage. That's true. The most restricted activity of banks, incidentally, in countries around the world is for banks to get into the real estate business. Banks are prohibited in the United States from actually owning homes and renting out homes. There was an exception made because of the housing crisis in the United States. So banks were told they have to get rid of banking assets if they foreclose on homes within 5 years. Real estate assets. So if a bank forecloses on a home, it has 5 years to get rid of the home. That limitation was loosened somewhat because of the severity of the housing crisis in the United States. And in my view, we had a housing crisis, and the housing crisis contributed to the banking problems. It contributed to a broader financial crisis, and that led to the worst recession, the so-called Great Recession, December 2008 to June 2009, 2007 to June 2009. Okay, so it started, in my view, in the housing sector. And, of course, it turns out, I won't go through these, but as you might expect, anytime you get economists together, or academics, basically, you always have pros and you have cons. I've never been anywhere when anybody's given a talk in which they say, everybody agrees. Ring fencing is great. Separation is great. There's, if I say something today and was totally new and different, tomorrow there'd be somebody, perhaps here at your university, would say, I'm wrong, okay, the evidence doesn't support my point of view. So you always get two sides to an issue. And of course, I'm sort of suggesting with respect to breaking up banks or dealing with too big to fail, it'd be nice if we do a cost-benefit analysis. It's hard. There's a Harvard law professor who says it's impossible to do a cost-benefit analysis of any banking piece of legislation. It turns out John Cochran at University of Chicago says it's difficult but not impossible. So we don't require cost-benefit analysis for banking legislation, incidentally. And I know of nobody, no one, anywhere in the world who's done what one would consider to be a thorough cost-benefit analysis of banking legislation, like the Dodd-Frank Act. So again, without good cost-benefit analysis, it's hard to know whether the net benefits are positive or negative if we try to do something to deal with too big to fail, like breaking up big banks. Even Simon Johnson, I don't believe, has produced any evidence whatsoever that the benefits of restricting size, the way in which I mentioned, would exceed the cost. So again, I mentioned separation. A problem that we have is that a lot of these subsidiaries or operation of banks operate in different parts of the bank, and the functions aren't necessarily tied to a legal entity. So if we had basically all these subsidiaries were separately functioning units and legally separate, perhaps we could seize one subsidiary or one entity and resolve it. But the problem is they're integrated in such a way, function and legal entry and operation are sort of mixed together, which creates more problems than if we had separate legally and functioning entities. That isn't the case with JP Morgan or any bank that I know of. So let me, you might see New Zealand has a rule. If you're a subsidiary of a foreign bank, you must be operational separable within 24 hours because they don't want anything leading to contagion in New Zealand. Incidentally, does anybody know who owns the Bank of New Zealand? It's an Australian bank, okay. They decided it's better for marketing purposes to have the bank be named Bank of New Zealand rather than Bank of Australia. New Zealand, not unlike Mexico, has outsourced and offshored its entire banking sector and hasn't had any real major problems. What about more and different capital? Okay, and let me just add a few. It's my view that banks do need more capital. What type of capital? I tend to be in favor of tangible equity capital. It turns out there's an issue of basically how much capital. Now, I mentioned Annette Admati. She has talked recently, she's a little bit vague sometimes, but she says a 15% leverage ratio, meaning 15%, and I assume she means tangible equity capital relative to assets, not risk-weighted assets. As you know, or you may not know, we have in the United States, and we have under the BASEL committee recommendations, two types of capital requirements. We had a Basel I, 1988, then we got a Basel II, we got a Basel 2.5, and now we're operating under Basel III, and maybe next Basel IV or 3.5. You get the message, okay? It turns out under the Basel Committee recommendations, you basically, if you had an asset that was risk-free, say U.S. Treasury securities, you didn't have to hold any capital against it. So the capital requirement would be 0. But if some assets were risky, then you'd have to hold capital against those assets. If you held, for a while, it was if you held sovereign debt in a country, the regulatory authorities would say that debt, if it's sovereign debt, is risk-free. Now, do you think Greek debt was risk-free? Okay, and the banks could hold it. It turns out, do you think home mortgages or mortgage-backed securities were risk-free in the United States? Well, the risk rating wasn't that high here in the United States. The problem is if you looked at the banks in the United States that got into trouble during the financial crisis, almost all the banks had adequate capital or were well capitalized using risk-weighted capital requirements. But they weren't if you looked at tangible equity capital relative to assets. It turns out the biggest bank, Citigroup, had about a ½ percentage point of tangible equity capital relative to assets. So many people would have said Citigroup was at or near insolvency during the crisis. And as you know, it received government funds. So did a lot of other banks. So again, on a risk-weighted basis, it turns out it had enough capital, according to the regulatory authorities. That would have been true of JP Morgan Chase, or Bank of America is a better example. The two most troubled banks, in my view, were Citigroup and Bank of America, okay? So depending on how you measure capital and whether or not you measure capital relative to risk-weighted assets or non-risk-weighted assets, you get a different view of whether or not a bank is solvent or not. In my view, it does matter, and I like the unleveraged or non-capitalized, non-risk-weighted asset ratio. Do you know, until recently, until Basel III, there was no non-risk-weighted capital requirement internationally being recommended. We did not require that banks have to hold an unleveraged capital ratio. It turns out it was an issue in the United States in the one of the former heads of the FDIC, Sheila Bair, was promoting a non-risk-weighted capital ratio, and she was overruled by the other regulatory authorities. Now, in the United States, internationally, there's a leverage ratio, tangible capital leverage rate. It's 3% that's being recommended. In the United States, it goes higher, but 3%. So yeah, and what does that mean? If assets decline in value by 3%, you're wiping out the capital of that bank, and the bank would become insolvent. Then you have to do something with the bank. So here, there are banks that are called GSIBs. I don't know much about your backgrounds. Does everybody know what a GSIB is, or does somebody not know? Sorry, I'm not going to tell you, okay? No. Globally, systemically important banking institution. You could say globally important, systemically important financial institution, that'd be a GSIB. A GSIB would be globally systemically important bank institution. I believe today there are 28 or 29 GSIBs. These are banks, the Financial Stability Board, this group set up by the G20 countries. How many countries belong to the G20? 20. No, 19. The European Union is also counted as a member, okay? See, sort of, you like those trick questions like that? G20. It turns out, though, we have GSIBs, and in the United States, we have several of our banks are GSIBs, like Citigroup, Bank of America, JP Morgan Chase, Wells Fargo. But not all of our banks are. But in the United States, we also would have had domestic SIBs. That's domestically systemically important banking institutions. So those two designations. Why does it matter? Because the GSIBs, they're considered to be globally systemically important. One of those banks fails, like Citigroup or JP Morgan Chase, they could have adverse implications for financial sectors and real sectors in countries in other parts of the world. So they have to hold more capital than other banks, and they're subject to more stringent regulation. And that means their compliance costs go up. The capital costs go up. Is that good or bad? Sort of it's an issue. Or does it lead to efficient banking system? Now, in this country, we have domestic SIBs. Now, what's the difference? Well, a domestic SIB is any bank holding company with $50 billion or more in assets. And $50 billion you think is a lot. Well, probably not even to Bill Gates, okay? 50 billion, well, I guess it would be. He would be a systemically important what? Individual, okay, since he's worth more than 50 billion. Warren Buffett too, but we don't designate them as systemically important, but the banks do. So we have mega banks in the United States, and you might think of the GSIBs in the United States so identified as mega banks, and then we have these other banks that are regional banks. And I can't think of one here in Texas, okay? You used to have some big banks, okay? I don't think you do any longer. You don't have a mega bank, okay? They don't in the Minneapolis Federal Reserve District either, incidentally. So you remember you had a Federal Reserve Bank of Dallas, former president, the previous president, who said the big banks perhaps should be broken up. But he had no big banks. And do you know who elects him as president? The banks. So who elects the president of the Federal Reserve Bank of Minneapolis? The banks. If you don't have mega banks, do you think the president of New York Federal Reserve Bank is going to say, I want to break up all the big banks? Maybe not. Or the Atlanta Bank, where you have Bank of America. So maybe there's a political economy aspect to some of the recommendations being made by some of the regional bank presidents, if not people at the Board of Governors. But I already told you, I'm not in favor of breaking up the big banks, or I'm not in favor of Simon Johnson's rule. So, but I do think banks need more than 3% capital to asset ratio. Measuring capital, tangible equity capital, and so that's we call it a leverage ratio, okay? More, how much more? Annette Admati says 15%. I've heard her say 25 or 30%. And you're familiar with the, well, I don't want to get into too much jargon. I've chatted with you a little. How many of you know about the Modigliani-Miller theorem? Modigliani-Miller? Okay, she said it has nothing to do with Modigliani-Miller, that she would advocate more capital, but she says you don't get a negative impact. There's a theorem in which two economists or finance professors basically shared the Nobel Prize. They said if you change, in a certain world, if you change the debt to equity mix, it doesn't affect the value of the firm, okay? There's sort of, it doesn't really matter with respect to the value of the firm. She just doesn't say that. Incidentally, just for your information, Modigliani and Miller disagreed over its applicability to banking. Miller said it doesn't affect a bank's value whatsoever if you take capital away from a bank or you add capital. The value is affected. Modigliani testified in U.S. Federal District Court, it does. They disagreed over what got them in large part to share a Nobel Prize, okay? So they're on record disagreeing over its applicability. Just for information, the only way you'd find out about there's a New York Times article telling about the disagreement between the two of them some years ago. But she just simply says, if you add more capital, you prevent banks from engaging in risky activities, and you protect the public if a bank gets into trouble. So I wouldn't go to 15 or 20%, but certainly more than 13% capital asset ratio. Here's the Basel III capital requirements or guidelines. The Basel Committee makes recommendations. It doesn't impose restrictions or requirements upon banks in different countries. That's up to the regulatory authorities. But you can see here, it's fairly complicated. Do we really need all that? I'm not a big fan of the complexity associated with capital requirements. I favor of more simplicity. And I'm not going to go through these different things, but this tells you the timeline. And I've also done it for the United States, okay? We just have a lot of requirements imposed on banks. The question is, are we really being uniform? The G-SIBs, how do we identify them? Size accounts for 20%. There's complexity. There's 5 factors. What about the domestic SIBs? We don't know, okay? MetLife was identified as a non-bank, systemically important financial institution. It filed suit and said, we don't want that label. It's not appropriate. We don't want the Federal Reserve to regulate us. We don't want them to tell us we need to hold more capital. We don't want stricter regulatory supervision of our activities. U.S. Federal District Court, District of Columbia, ruled that the Fed inappropriately, or the Financial Stability Oversight Council inappropriately gave them that designation. We don't know if it's going to be appealed. It turns out we don't know the criteria that's used for the domestic SIBs or the G-SIBs. They're not the same criteria as used for the G-SIBs here in the United States. Just tell you, complexity. Banks now, they're also subjected to, does anyone know the phrase CCAR? Other than a few of us. Okay, banks also are now required to sort of determine if they have appropriate capital given the riskiness. We have what's called DFAST, Dodd-Frank, sort of a stress testing. Banks are incurring a lot of compliance costs. So again, will all those costs adversely affect the performance of banks? Or do they actually provide safeguards to be sure we achieve financial stability in this country, that we have a safe and sound banking system? We can go too far, and I think we have with respect to some of the regional banks and some of the smaller banks. I think we've overreacted to what happened with respect to the financial crisis. I don't have time. It turns out Ryan mentioned this Guardian of Finance book, which did get an award, and it turns out there we blame the regulatory authorities for a lot of what happened with respect to the banking sector and the problems in the banking sector. And I'm almost, what to do about, I'll skip that. When I say what to do about them, the Dodd-Frank Act has in it, here in the United States, what's called orderly liquidation authority. It's believed now, if you're a believer in the Dodd-Frank Act, no bank, regardless of size, is too big to fail. I don't think that's probably likely to happen. And how will we know? We have to wait until we have another big bank get into serious trouble. Then we'll know whether or not it's bailed out or not. We always have to rely on the political elements to determine whether or not we're going to bail out a bank. And we bailed out some banks. It turns out, I don't think we're going to know if we're going to bail out a bank or whether all banks or no bank is too big to fail. Small banks fail. We had the most bank failures recently in the state of Georgia. It turns out they're all small. Big banks obviously receive government funds. It turns out we won't know if the FDIC, with its new authority, will indeed allow a bank to fail. We allowed Lehman Brothers to fail, just over $600 billion in assets, but the government helped arrange for Bear Stearns to be acquired. It turned out stockholders lost money, creditors were protected. So Bear Stearns was about $400 billion, Lehman Brothers was bigger, and the chairman of the Fed said we didn't have the tools to do anything about Lehman Brothers. But again, I'm not sure and don't believe we've solved the too big to fail problem. It turns out, I'll just mention, countries, anytime you have a financial crisis, countries have done things. And they all would like to tell everybody, their citizens in particular, we've solved the problem, okay? It turns out these countries have all said, and you see the question, and it's not meant to be, don't think you need glasses. If you can't read this, you're in the back row. Say, gee, I can't see it. I have glasses up here. It's just, all it tells you is countries all said that we now supervise systemically important institutions differently than non-systemic. They'll say yes. They're now all going to try to deal with the systemic problem of big banks. But when you look across the board here, it turns out they all do different things. So what we might be able to do is see which works best with respect to what they're doing, but we'd have to wait until there's another crisis, right? Why don't they all agree? Do the economists, the finance academics in these different countries disagree? Would they agree with one country doing it the right way, the US, or other countries doing it the right way? We don't have a clear view. So what happens now is we're doing just about everything with respect to regulating the banks in different countries. The problem is, are there different approaches, complements or substitutes? We don't know whether there really are. Working together, whether banks should, basically, if they hold more capital, should we just not regulate them the same way with banks that have less capital? Bank voluntarily holds a lot more capital. Is that a way, basically, we can actually reduce regulation in those banks? One of the banks was telling me, the CEO of a bank was telling me, they hired like 30 more, and this is a relatively small bank, 30 more employees. And you know what their job is? Simply to deal with regulation. And you can ask people like that and hire all these additional employees to deal with regulation. Are those employees making loans, servicing customers? No, they're just dealing with the compliance requirements, the new compliance requirements. So again, if you look at banks, a lot of the banks, their costs go up, but the revenue doesn't go up proportionally. And it may be due to the regulations, meaning the revenue-cost ratio is going down because a lot of banks aren't contributing to revenue, they're only contributing to cost. And I think this is what I just told you. Banks are doing a little bit of everything. Regulators are doing a little bit of everything. What are our reforms? We reduce market, we want more market discipline. We don't have it. I'm a big fan of market discipline. It turns out we don't have enough knowledge. There aren't enough studies telling us whether or not basically regulation is beneficial. The regulations we have, the reforms we made based on a cost-benefit analysis, as I told you, it's a controversial area, but a needed area. People are saying we should do more of that. We do it with respect to other types of regulation. We have to deal with regulatory captures or bias. Just briefly, I think I have a minute, I can tell you, what do we mean by that? The regulatory authorities, as I told you, I believe contributed to the financial crisis in this country, and it's documented in the book that Ryan mentioned. Guardians of finance, who are they? The regulatory authorities. Here's the analogy. There's a book written by a University of Chicago professor and a Sports Illustrated columnist. You know what they found when they look at sports in countries all around the world, all different types of sports? The umpires or the referees are systematically biased in favor of the home team. Okay, systematically biased. Soccer, baseball, football, you name the sport, you go to the country. Systematically biased in favor of the home team. Now, we use that analogy with respect to the financial regulators. You tell me, who do you think we identify as the home team? I don't want to ask you again unless you want to take a stab at it. What's the home team for the regulatory authorities? Yeah, or the financial institutions they regulate. And many, you're quite right, every president, I think, but every president of the New York Federal Reserve except the first one came from the financial industry and went back to the financial industry. That's called the revolving door. But the home team is the institution being regulated. What's the away team? In the nosebleed seats, you know, at probably your basketball stadium when you're way up away from the floor. The taxpayers, the citizens, okay? Who meets with the regulatory authorities? It's the financial institutions being regulated. They have the time and the funds to meet with them. See, so we thought there's this bias. How did we eliminate the bias in some of the sports? Does anybody know what the two words are? I-R, the first two letters. Blank, blank. First word begins with an I, second word with an R. Instant replay, right? You throw the flag down, soccer, whatever. Instant replay. We have no instant replay for the Federal Reserve, the regulatory authorities. Maybe we need instant replay. We need to somehow eliminate the bias, okay? It's a way of saying these regulators aren't evil people. Maybe they're just biased, okay? Maybe there are other reasons. We have to deal, though, with this regulatory capture. Now, I'll close. Will history repeat itself? This is a slide. I usually go back to 1790, but it gets a little messy. This is a slide showing you, and you don't have to try and read it. You're not banking regulatory type people, but this is all the major laws enacted to deal with banking problems. Do you know when those laws were enacted? What do you think? Before or after a crisis? After a crisis. There's not a single law, that important one, that was in anticipation of a crisis to prevent it or mitigate its effects. They always come after the law. And every single president, including President Obama, when he signed into law the Dodd-Frank Act, okay, when he signed it, uses two words. With this law, blank, blank, will we have a banking crisis? What are the two words? Never again. Okay, with this law, we'll have and you wait 20 years, and then we have another one. And over time, the crises have gotten more frequent and more severe, including the most recent one. What's wrong with our presidents? They're using the law. With this law, we'll be free of a bankrupt for another 20 years. Why not tell us that, right? That we haven't solved the problem. We've just postponed the problem another 20 years. It always works out that way. There are a few laws that just had to be enacted because the marketplace was changing. That's the slide, including the Dodd-Frank. You see the long name. And sorry, anytime you like a law, Dodd-Frank means Senator Dodd represented Barney Frank from New York. If they like the law and think it's really going to be good and the public will like it, they attach their names to it. The chairman of the appropriate Senate committee and the chairman of the appropriate House of Representatives committee, they sign their name. What don't they sign their names to? Tax acts, when we raise taxes. You don't see any names with the tax acts, but you see it for banking legislation. And occasionally they're nervous. Now, of course, they're not sure they like it, okay? And we get what with every new law? More regulators, okay? Would we have this regulatory structure if we started? No, of course not, of course. But it turns out that we get more. What's the most recent regulatory agency that we got with the Dodd-Frank Act? We never eliminate a regulatory agency. Ryan knows this, having been in Washington a long time, knowing how it works, those sorts of things. It turns out when we had a regular savings loan, they got into trouble, and the regulatory agency did a bad job. You know what we did? We said, we're abolishing the agency. You know what that meant? We took the plaque down in the building and put up a new plaque. We gave it a new name. And everybody got a raise and new titles, okay? That's exactly what happened, okay? So in this law, we abolished one agency. We abolished what's called the Office of Thrift Supervision. So what happened to it? Well, we didn't put up a new plaque. We merged it into the Office of the Comptroller of the Currency. Okay, and they moved into a new building, and probably the pay schedules changed. But that's what happens. But we got another new agency because of now the work, I think, largely of Senator Elizabeth Warren. She was, before she became a senator, does anyone know what she did? She was a Harvard Law School professor. I had the opportunity actually to debate her once, okay? A terrific debater, okay? I won, but of course she's still a terrific debater. It wouldn't sound good if she was a terrible debater. No, I didn't win, okay? You don't win on those things. But she's very smart, very articulate. But she advocated the Consumer Financial Protection Agency. The Federal Reserve was supposed to protect us, and the other, they didn't, so she wanted a new agency. Bankers weren't too happy. She didn't get the position of the first director. Instead, she became a senator. Nobody knew that would happen. Unintended consequences. We don't want her to be the head of the state. Now she's a senator with a lot of power, okay? So she became a senator. So we have the Consumer Financial Protection Agency in existence in Washington. What is it supposed to do? Protect us. And I'm going to exaggerate now, okay, for effect. So the agency says no bank should make a mortgage loan, because we had a mortgage crisis, okay? Remember subprime mortgages? Do you know what a ninja loan is? Somebody gets a loan with no income, no jobs, no assets. They call it a ninja loan, okay? Do you know what a liar loan is? Did you read Liar's Poker? Did you see The Big Short? Anybody? Terrific movie, okay? Or Spotlight, okay? We need the spotlight on the regulators. It turns out, basically, what's a liar loan? What we used to do is you just ask people, what's your income? And they would tell you. And you say, good, you qualify for a mortgage loan. Are you sure it's not higher? Okay. And those were called loans. We had what are called Alt-A loans with no documentation. So you didn't have to provide tax records or pay stubs, any of those. You just say, what's your income? Again, so in the housing sector, so it started off that the Consumer Financial Protection Agency is telling banks now, don't make any loan to anybody to buy a home unless you know for certain the borrower can repay the loan. Do you think that's a good regulation? You do. Okay, so you come to me and I'm the lender. How do I know if you can repay the loan? Your income statement, tax records, down payment. But can I be actually certain? No, there's some uncertainty. So you can see the problem is, now I'm giving this is exaggerated, but that's sort of what we're getting into, that type of world. Can the lenders actually know who's going to default? I do work in the payday lending industry. Do you know which state has the most payday lenders in this country where they're legal? Some states prohibit them. Which state? The great state of Texas. Okay, and you have you know what the average number per county is of payday lenders, and all the counties allow them? 6.2. You have a county in which there are over 700. I haven't been to that county. I assume I'd see a lot of payday lending stores, right? So the great state of Texas has all these payday lenders. I was talking to a reporter there, and I told her about this county, and she says she's going to check into it. I haven't, okay? And Ryan assures me it's not where he lives, okay? But again, they say the interest rates can be quite high. So our financial system is important. Banks are important. We can't over-regulate them. We can't try to force them out of business because we have the so-called shadow banking sector. If we over-regulate banks, if you take the risk out of banking, you take the profits out of banking. You know that. Risk is associated with lending, okay? And banks make loans. It turns out we have a shadow banking sector. Have you heard that phrase? Financial firms that operate in the shadows. Okay, payday lenders will be part of that system. Insurance companies, mutual funds, money market funds. Again, hedge funds, private equity, will they start taking on risk? They're buying homes, renting them out. Home prices go up. They can start selling the homes, make a profit. Why? Banks can't own homes. Do you think banks should be able to make real estate loans? In addition, should they be able to rent homes to people? Are you in favor of that? Yeah, you don't know. But they're prohibited. It's the most prohibited activity in countries around the world, is to actually own real estate. They can make a loan, real estate. Can banks hold junk bonds? No. And we used to tell the banks, you can only invest in investment-grade bonds. If you buy a AAA bond, all you know is you're paying the highest price, and the only thing the price can do is do what? Go down, and you get the lowest interest rate. Would anybody knowing finance ever buy a AAA rated bond? If you know the price can only go down, you're assuming whoever rated it, you're going to get the lowest interest rate? Not until recently you would have been better off buying what? Below investment grade securities, simply not AAA. So again, there's a lot going on in finance. Banks are important. We still have a lot to learn, and I think I'm right about on the mark before Ryan grabs me, tells me to stop. You're free, if Ryan doesn't object, ask me any questions. You can disagree with me. If you do, of course, I ignore what you say.
We have time for some questions. If you could just repeat or summarize the question, if you wouldn't mind, when someone asks you a question.
Okay.
That'd be great with your shorter mic.
Go ahead.
Hi. So, with regard to the repeal of Glass-Steagall, what effect, if any, do you think that had on the Great Recession? It doesn't have to necessarily be a direct effect, but even as an exacerbating factor, do you think it played any type of a role there?
What effect did the Glass-Steagall Act have on the financial crisis or the Great Recession? The Glass-Steagall Act, basically, you go back in time, two members of Congress, Glass and Steagall, one from the state of Alabama and I, what they said is because we had a stock market crash just before the Great Depression, banks, they attributed to the fact that banks can engage in securities activities as well as banking activities. J.P. Morgan Chase, okay, was also Morgan Stanley and a bank, so they were separated. It turns out the Glass-Steagall was basically repealed. Graham Leach Bliley said banks can engage in not only banking activities, but securities activities and even insurance activities through financial service holding company. Zero impact. The 5 major investment banks got into trouble, okay, and they were not banks at the time. It turns out we had 5 major investment banks. It turns out 1 was allowed to fail, Lehman Brothers. It turns out only 2 were left. 2 others were acquired by big banks, allowing banks to get bigger, and now some say they're too big. And the ones that are left are Goldman Sachs and Morgan Stanley. Then they converted to banks, and they gained access to the Federal Reserve discount window and TARP funds, basically. So I don't think the repeal of Glass-Steagall contributed to the Great Recession or the financial crisis. The investment banks got into trouble. They went into what's called private label securitization. They were securitizing mortgages just like Freddie Mac and Fannie Mae, our 2 housing giants were doing. So we got what's called private label securitization. That is the non-government agencies involved in securitizing mortgages. Yes?
In February, there was a brief but very violent decline in the stock prices of some major banks in Europe. Depending on who you ask, there's a confluence of China slowing down, low oil prices, negative interest rates. How well prepared do you think American major banks are for those recent threats that have emerged, and how well do you think we can prepare for risk from other countries spilling over into our financial system?
Yeah, another very good question. As if I really knew. Okay, I'll pretend I know something and try and answer it. But yes, China slowed down tremendously. If you can believe the numbers, the growth rate in China. China is the fastest growing big country in the history of the world. They've doubled their real GDP per capita more times in the U.S. in fewer years than any other major country. A great story about China. China's slowed down tremendously. We don't know how much because the numbers, we don't know how reliable they are, but I think everything suggests they've slowed down a lot. Even if it's overstated, it's slower. It's now the target's 8%. Used to be a lot greater. But you would expect China to slow down, having grown so rapidly so long. Oil prices were down. They're up a little more, way below what they were. So oil price, you mentioned a factor. China's slower growth. It's hurting Brazil. It's hurting Australia. When China was importing a lot of commodities from other countries, those countries are suffering. I think our banks today are better capitalized than they have been for years. They have much more capital, and I think much more real capital. So I think they're better able to weather those sorts of problems, unless things get a lot worse in some of those countries. As you know, we're a more globalized economy. Everybody says that, and I say in terms of trade dependencies. But our exposure to China is relatively small compared to other countries, like Brazil. Brazil, it's in terrible shape. Australia's been adversely affected by China. We haven't been that adversely. Ours is domestic. Have you heard of this book by Robert Gordon, say The Age of Productivity Growth is Over? Okay, Robert Gordon, Northwestern University professor, he's thrown out the challenge saying, where's the growth going to come from? It's not coming from technology. He says the major financial technological innovation occurred years ago, he says. You know, the steam engine, telephone, airplane, all those sorts of things. So where's it coming from? So it's a debate. Is modern technology going to generate more growth, growing inequality associated with what he says and that? I think our banks can weather it. Here in Texas, oil prices, energy sectors hurt in your state. I assume there's some fallout in the state. But the banks, some banks are more exposed than others, but the exposure isn't that great given the capital today, in my view. It'd have to get a lot worse, and oil prices seem to have stabilized. But don't forget, you got into trouble years ago in Texas because you, in Houston, Dallas, you put up all these office buildings, and they were see-through offices. You know what that meant? Nobody was in them. But guess what? Half of the problems in the savings loan industry were in Texas, your great state. And we bailed out Texas. You know, there was movements in Congress, as Ryan knows, to tax Texans extra because the problems, half the cost of bailing out the savings loan industry was due to problems in Texas. The argument was, no, we share the problems. Okay, should we have? Probably not. We should have let you people, no. We probably should have shared them. But that was a problem. So I think the banks are in much better shape. I worry, though, if another big bank engages in excessive risk, there will be a problem. We have some...
Yeah, somewhat two-part. My understanding is the thinking on the reform either divides into two camps. One, break up the big banks, and two, provide more capital. Are you saying you disagree with both of those positions?
Yes.
Okay, then never mind on the second part. Would you then expound upon your position about how you might engender more stability in the financial sector?
Yeah, that's good, because I really didn't say that. Just briefly, the reason is the Simon Johnson is one restricting the size. We have a restriction on acquisitions in the United States already, actually. No bank can acquire another bank if its total share of domestic assets nationwide goes above 10%. That was a cap on Bank of America go nationwide. And we also have some caps on within-state acquisitions. So for the first time under Dodd-Frank, if you didn't know it, banks can now branch anywhere in this country. It didn't happen until Dodd-Frank, July 2010. Earlier, we allowed banks to do acquisitions nationwide, and that was the Regal-Neal legislation. That's what banks can do, any acquisition anywhere nationwide. It took a long time in a capitalistic country, right, a democracy, for banks to be able to expand anywhere they wish. Okay, but it turns out, with respect to different, the Volcker Law is opposed. That's like separating activity. You can't engage in certain things. I don't think we know enough about economies of scale and scope, and I wish we had more evidence. Then we can say, don't restrict that. There's a cost, and it's not clear about the benefit. I think capital. More capital is the first line of defense against problems in the banking sector. More owners' capital at risk. They presumably will engage in less risky activities. More capital. Non-leveraged, non-risk-based capital, tangible equity capital. If you looked at tangible equity capital and market value, to book value ratios, they were highly correlated during the crisis. Meaning as market value went, so did tangible equity capital. So everybody was paying attention to tangible equity capital or they're paying to market value. So capital, first line of defense. Then I think we have to wait and see Dodd-Frank, all these requirements. And I would only, I'd lighten up on all the small banks and the regional banks and set a much higher threshold for domestic SIFI. I wouldn't set at 50 billion, like 250 billion or 500 billion. The truly big banks, I think, are the ones where we have to worry a great deal. Don't forget, if all the banks get involved in real estate, and a lot of banks were, half of all the loans, over $4 trillion in loans at our banking and our banking industry were home mortgages. Okay, real estate loans. When the real estate bubble occurred and home prices went up, they were going up at such a rate that Bill Gates would have been priced out of the home market, okay, at the rate at which they were going up. And then when home prices collapsed, all banks we knew would be into trouble. And there's some people who made a lot of money. One gentleman, a couple $2 billion, betting that home prices were going to do what? Go down. So he was shorting mortgage-backed securities. And you could have taken out office credit default swaps, you know, basically naked credit default swaps in the market. All I'm saying is basically, if all the banks are engaged in this, have the same asset portfolio, and that asset inclines in value, and then it goes down, they're all in trouble. So you have to look at different banks, their business models, and if they differ, that becomes very important. So I think we have to do more in that respect. And we have to make sure the regulatory authorities do their job. As I said, my view is the regulatory had the power to take more action earlier. And if I went through, and I'm not obviously going to, given the time, and it's time for you to have a drink and have dinner, which is we need to basically hold the regulators accountable. No matter what happens to the regulatory things, nothing happens to them, right? They leave and they go back to where they come from, or they go back and they earn a little bit more. So we have to somehow hold them. I'm not saying, you know, put them in the, you know, waterboard them or anything, you know, to contact and say you're going to be waterboarded for your performance. No, but have better incentives. Incentives matter everywhere. So incentives for regulatory authorities and bankers themselves. But I don't think we could just blame Wall Street. That's part of my message. We have to say, what were the people in Washington? What did they know? When did they know it? Any other questions? Or is that it?
We'll have to draw it to a close there. If you had a question that you didn't have a chance to ask and you'd like, I'm sure Jim can stick around for a couple of minutes if you'd like to come up. But I'd like to take him up on his challenge to us to go out and have a drink and dinner and continue the conversation that way, which some of us will do. And if you are political junkie, for the political junkies in the room, the center will be hosting Jonathan Martin from the New York Times just 2 days from now over lunch. Is it in this room, Lauren? In the same room. From the New York Times, fresh off the campaign trail. He'll be here to help us interpret this crazy election. So please join me in thanking Jim Barth today for his comments. Thank you.